We're going to go ahead and get started. Welcome again to the weekly Market Insights webinar through FreightWaves SONAR Freight Market Dashboard. For those that are returning, this is not a 101 session. We're not going to really spend much time on how to create pages, custom pages, how to create custom charts, maps, any of that stuff. We're going to focus more on some of the new data sets that we've input and how to use them in your market analysis. And do not forget your Q&A up top here. If you have a question during the webinar, if it is simple and we can ask it or answer it very quickly, we will go ahead and do so. If it's a little more in depth, we'll wait until the end and try to get to all the questions there at the end. And for those of you that are SONAR subscribers or are currently working on a free trial, don't forget your Knowledge Center. The question mark on the top right exports you to our FreightWaves SONAR website with all of the data sets listed, the explanations, the frequency that they're updated. All of these webinars are listed on there, and also Zach, the Sultan of SONAR, the expert, all of his market insights that come out every Tuesday are listed on there as well. So with that, we're going to go ahead and get started and explain one of the more recent data sets that we've added.
So real quickly, the difference between the Freightos West Coast and East Coast numbers or dollar values are important for shippers who are trying to make the most economical decision and getting their freight from China to some point on the East Coast of the country. I think that's all I'm going to say about that moving forward. Obviously, go to our website for further explanations and how you can get value out of that, or contact one of our sales representatives, send us emails, all that fun stuff that you can do nowadays on the internet. Lots of ways to get in touch with us. So I am going to move on.
Yes, and a quick teaser for what's to come, which has been on the horizon for quite some time, but the amount of the data and the legwork behind it has proven to be quite a lot, and that's the customs data, which will be a very nice little tool alongside of the Freightos data sets and showing the container pricing. You'll be able to see, once we have that input to SONAR, which is coming very soon, the actual commodities that are entering U.S. ports, the volume as well, by U.S. ports specifically, and that's very soon to come here. So just a little teaser. But go ahead. I know you want to talk volume next. Outbound tender volume. What does that mean? What does it tell you region by region, and how can you use it?
Yes. So again, if we kind of lose connection again, we do have a backup. So hang with us for a second.
Yeah.
We figured something out in the middle of that mess. But so I'm going to talk about something that isn't in SONAR just yet, but it's going to be in SONAR very soon, as in the next 24 hours or so. And that's going to be the volume spreads. It's going to be called the head haul index. And what that's going to tell us is basically the exact nature of any market in the country. A lot of people have their own general ideas of what's considered head haul and back haul in the country. The back haul lanes are ones where you can't get freight out of, and head haul lanes, you're moving in there, you're going to get a load out of there. So when you have this in and out kind of mix of freight, so at any given time, a market can be a head haul lane or a back haul lane. Seattle, for instance, is considered an area that you're going into, you're not going to get out of very easily. That can change in November, for instance, when the apple season hits, and you can actually get more freight coming out of Seattle than going in.
And Christmas trees.
And Christmas trees as well. Various times a year, this switch kind of happens. So if you can take advantage of this, if you're an asset-based carrier, this is very valuable information to know. Because if I'm sitting there trying to figure out where to position my trucks, the salespeople are coming in saying, hey, I've got this sweet North Dakota to Seattle freight. You happen to have 2 trucks in North Dakota that you're dying to get out. But you're thinking, oh man, not Seattle. Seattle's a terrible spot to go with my truck. Well, you can go and check your head haul index. And what that's going to do is be the difference between the outbound tender volume and the inbound tender volume. And basically, when the inbound is higher than the outbound, that means that you're going to have potentially more trucks in the market available than there is freight available. And when the outbound is higher than the inbound, that means there's a huge demand. There's probably a demand for freight that's going to happen. I'm going to check my tender rejection indexes, and I'm probably going to have a little bit more pricing power in the space if I'm in the spot market. Obviously, on the contract side of things, it's just a good thing to know in general. You might think about positioning. I mean, some of the higher level people that make decisions may be able to position their capacity in order to capture some market volatility, for instance.
But using that example though, and in the limited transportation experience I have, I'm sure we have listeners on here that have decades of transportation experience. And what if I know that it's going to be apple season? And what if I know that it's going to be Christmas tree season? How is this going to help me, whether pick any one of the transportation participants, whether it be asset broker or customer? How does this actually help me if I know these things are coming?
So you know these things are coming. That's true. And most people do know. I know that produce season's coming every year. But what I don't know is when is produce season coming. Right. And it's not like somebody just raises a flag and says, it's produce season time. Here it is. Yep. Right now. No, it doesn't. Nobody knows until it's too late. And that's really where this volume spread kind of kicks in. And what the chart's going to show you when we do kick this off, it's basically going to be this positive or negative value. And the absolute value of the number is not that important. That's one of the things that's probably going to be the hardest to understand. Just like the absolute value of this line here on the outbound tender volume index that I'm showing you. And I guess I should probably explain the outbound tender volume index, even though it is a few weeks old, but there may be some people on here that probably don't fully understand. The outbound tender volume index basically is a way for you to gauge what the relative volume is in a market. So it's based off of a March 1st value. So I'm going to go ahead and zoom all the way back to March 1st. That was 6 months ago, right? Mm-hmm. Or before 6 months ago. And so right about here, when this value was about, what is it, 250, at that time, that was kind of the indexed value of how many accepted loads were in the market. Currently, there is 266. The value is 266. So there's some percentage. If you divide 266 by 250, that's how much more percent loads there are moving in that market. And why that's important is essentially kind of measuring, what impact does volume have on capacity in the market? If volume goes up significantly, real fast, we all know that puts a lot of pressure on the carriers to kind of go in there and fill those, that space and carry the loads. So when volume drops significantly, you tend to have a lot of excess capacity with carriers with not having a lot of options to get their trucks moving again. So the volume spread is going to give you a number that kind of tells you what kind of state is that market in right now. Is it a head haul lane, a back haul lane? Am I going to have any trouble getting my truck out or in? If it's a positive value, I shouldn't have any trouble getting my truck out of that market. If it is a negative value, I'm probably going to have significant trouble getting my truck, or significant issue getting my truck out of that market. So the example I have pulled up right here is Allentown, Pennsylvania. And this one was interesting to me just because right here, the spread is widening. So I'm getting a lot more loads going out of that market than coming in all of a sudden. Now, again, this is just a couple of days of movement. So it doesn't necessarily mean that, I need to go rush the load boards and start throwing spot rates out.
When you see that, though, it's helpful to zoom out really quick and look at maybe the trend of that market and kind of what is, let's call it the normal, or what is the average, which you can certainly throw average lines if you want to get fancy.
Now this is a true index. So what that means is this value is going to, at least in the near term, hover around what's considered kind of an average point. So this 250, you see, hasn't moved very much off of this 250, except for this, these couple of holiday sessions here, and then up here in peak season. This right here, this space right here, is really what I'm looking for. I'm going to go ahead and throw a baseline on that just so I can. So here's 250. And what I've done is I've kind of changed my chart around a little bit. And I'm going to go ahead and eliminate the spread. And so I know that here's my March 1st value. And that's kind of what the reason we developed this index was to try to figure out where the best middle point of trucking volume is. March 1st was figured to be one of the better points because it's as the freight market is kind of starting to pick back up out of the slow season. But it's not at peak by any means, but it's kind of considered an average time of year. Obviously, that doesn't work for every market, but we picked the point that we thought represented the midline of freight markets in general. So you can't go out there and apply it to every market. But again, if I'm just trying to get a basic understanding of what the outbound tender volume index is in Allentown, Pennsylvania, because I don't deal with it very much, I essentially go back to this March 1st date to kind of start there. And then this baseline figure kind of highlights the regions that tell me where I'm experiencing less than average volume and higher than average volume. And there's other ways that you can do that with the studies. I'm not going to get too deep into the studies during this session, but maybe in a future webinar, we'll go through some of these studies. These are technical, very base level technical analysis type things, but all they are essentially is giving you an easier way to visualize the data on the platform so that you can actually make sense of some of the things you're seeing, because really the point here is this absolute value is probably meaningless to a lot of people, including myself. Like 266 in Allentown, Pennsylvania probably doesn't mean too much to anybody. But what is important, what is meaningful are these jumps right here and these moments where they're actually above the midline. So right here, another little technique that you can use with this baseline charting. Again, this is just an easier way to visualize the same data so you can kind of gain perspective on where it is. So you can see that it actually has crossed a point where it normally does not. It spends a lower amount of time in this range than it does down here in this red section down here. And that's a useful kind of item when you're trying to gauge, well, is this significant volume? Should I be concerned about it? And it looks like it is actually moving into a significant space of where we haven't really seen this much volume. Again, we had this section right here poke up briefly, but it is kind of an elevated volume for that market. So they may not have enough capacity in the area. And with the inbound tender volume, I'm going to go ahead and pull that one up separately. We can do the same technique, and you can see that the inbound volume has actually declined. It does not spend a lot of time in this inbound section. So again, this head haul, back haul concept, when there's less freight moving into the area, that means it's going to be more exposed to volume surges because there's going to be less trucks moving into the area. And I hope that kind of makes sense to most people. So this spread value, whereas when you see it, it's not going to, or a head haul index, I should call it, it's not going to mean much to you and as an absolute value, but it is going to give you a good idea, because what you're going to see on the chart is this kind of movement, this up and down movement. And as it gets bigger and smaller, that's going to give you an indication of what you need to be doing with your trucks. If you're a broker, I'm looking for those values to kind of, a lot of volatility. Those are going to be the markets that I'm going to be watching the most. I want to watch these things go up and down. I want them to switch signs a lot if I'm a broker. What I mean by that is it's going to go from a positive value to a negative value repeatedly. Markets like LA, Chicago, they can move in and out of favor rapidly over the course of the year. Markets like Seattle, they're gonna change their sign once a year, and then they're gonna go strong one direction. LA, for instance, is a good market to watch for any kind of port surging or produce movements to that regard. And this spread value or the head haul index, I should keep calling it,
Hmm.
is really going to be the biggest predictor of future rate movement, because those things are going to tell you, it's going to give you a better gauge of absolute capacity in the market over time. Now, it may not show up that day, it may not show up that week, but as these values kind of diverge and spread out, that's basically where you're going to see the largest exposures. So anytime that we see volume surge in an area and it's had a negative, or it's had a high positive value for a long period of time, that means your outbound has exceeded your inbound volume, and your market is now exposed if there's any kind of huge pressure to cover loads in the market, such as LA and produce season. And I believe we actually saw that this year a little bit, as we had we watched the tender rejection index. So I think we should illustrate maybe Seattle. We talked about that a lot.
Let's check out Seattle. I know we.
So this will be, I think everybody kind of understands what the Seattle market's kind of MO is. I'm going to go ahead and pull up the outbound tender volume index, Seattle, and the inbound tender volume index, Seattle, ITVI. And you're going to see the inbound has exceeded the outbound, as you would expect. What I'm looking for here are these tightening bands. And as the spread, like what you're going to see on the chart for the head haul index, is when these bands kind of shrink, that value is going to move closer to zero in this instance. And so if I'm watching Seattle closely, I want to make sure when that value becomes positive, as outbound exceeds inbound for that glorious moment in time when the sun sets in Seattle.
Yeah.
And all of a sudden I know, man, I need to watch, there's a trigger there or something I need to be paying attention to out of this market. Right now, it's got a pretty healthy head haul like value.
Yeah, and if I'm a carrier, then I want to until we have the spread, when looking at these two data sets together, it's most beneficial for me to be in this market when the lines are moving closest together, or when the spread is the smallest, if we use that term. Now,
the outbound value exceeding the inbound value is when I am positive as a carrier that I am going to be able to get a load out of that market. That's what I want as a carrier, as a dispatcher, mind you. It may not be the best thing for the carrier's revenue in total, depending on how much they move their assets into the spot market and out. As we saw earlier in the year, a lot of carriers did move their assets to the spot market because their contract rates were just not getting it done in terms of costs. So they had to go out there and make sure that they had the best chance of covering some of those costs. So they went into the spot market a lot. That obviously is not something that carriers like to do a lot of. They like to have their costs covered in their contracts, so load dispatches can effectively manage their networks to make sure that it's as easy as possible to get the drivers moving. Asset utilization goes up, especially when talking about things like Seattle. You're going to have more load opportunities into markets that you potentially think are not good. You're going to be able to make better decisions in markets that you really don't understand. Like you may not know this time of year that Chicago, for instance, is a terrible market to put your truck into. Actually, it's a pretty good market right now to put your truck into. And you can go here just to see which kind of cycle the market is moving in right now. So I'll go ahead and pull up Chicago because that is a huge market, especially right now. It's one of the only markets that we've seen kind of take off. So the outbound is actually exceeding the inbound, and I'm going to go ahead and change this back to a line.
And that's what we've seen in the tender rejections too, right? There's been quite an increase in.
Yes. So if I'm a broker, and I'm going to go ahead and state the case for the broker real fast in this situation. So when we've had high positive values and it increases significantly, like right here, when we see this divergence of outbound, so your spread number is going to get larger. When you see the chart for the head haul index, it's going to go up and to the right when this expands. And that's a big signal for me because I now know that my outbound volume is exceeding the inbound by a bigger rate. The market may not be able to bear the amount of outbound coming out of it eventually.
Right, and that's an interesting thing to bring up, I think, and probably I think we may have touched on it in a previous webinar, but understanding the process, I think, of what creates spot market volatility or what creates volatility in a market. And I think, as you mentioned, a leading indicator being the volume. Can you just kind of walk us through how volume can affect a market, and then what it takes to create tender rejections, and then
Yes, that's a good point. So volume, essentially think about the freight market like a balloon. The more air that you put into the balloon, the higher the odds are that it's going to burst. You don't know when that point of expansion is going to overcome the capacity of the market, and therefore when it explodes, you have market volatility, increased spot market activity, et cetera, et cetera. So more volume tends to lead to more easily destabilized market and more volatility in your overall situation. So I'm watching volume heavily because that's not the only reason that we see tender rejections, but it's going to increase your odds for tender rejections. And the higher the odds are, the more chances.
Well, and I think that's something that we saw with, was it Dallas or Fort Worth, with the increase in outbound volume, but they're operating at a fairly high inbound volume. I think that was the market. So really the outbound volume increase didn't affect them too much because you could, in tender rejections, it wasn't felt because
so in that situation, the difference between the outbound and inbound volume basically stayed flat, and they were also close enough together that the market could bear it. Indianapolis, for instance, we talked about that a little bit last week's market update. It was a solid example of a market that could bear a little bit more volume coming out of it, even though we did not have a lot of volume going in. Mainly because the Indianapolis market sits right in the middle of trucking central. Columbus is to the east, Chicago's to the west. It's also right along a corridor where there's a lot of trucks moving in and out. A lot of deadheading can happen in that market to overcome some of that lack of inbound freight taking up for the outbound freight. Certain asset-based carriers are going to know, hey, I'm going to end up 100 miles away. We're okay with that. They build it into the rates. It's fine. And that's actually something that maybe they don't know.
Right.
I say that like it's just common sense, but really that's kind of what some of these data points are telling you. They're giving you the data to kind of validate something you may already know, but you don't really know.
Yeah.
And so with Chicago, for instance, right now, you've got a declining inbound value, which is, that's a huge red flag for me, knowing that Chicago is not a market that people avoid. Chicago is a huge hub for the Midwest. It services all over think about a hub and spoke kind of network: Minneapolis, Milwaukee, Indianapolis, Detroit, St. Louis, a lot of rail yard presence right there, a lot of intermodal. We're not getting a lot of trucks moving into the Chicago market. It is a huge production center as well for industry. And I think if any of you are following some of the economic indicators, you'll know that industry is still cranking. Manufacturing is still up at elevated levels. So any kind of surge in volume in Chicago is going to leave it exposed. And one of the things we haven't figured out yet this year is, and I'm going to go ahead and pull up our favorite Try Shy, just to kind of illustrate, we see that tender rejections, contrary to the market in general, outside of this initial drop right about here, and I'll go ahead and compare this to the outbound tender rejection index in the United States, there's a huge divergence between the two values. And this right here means this widening gap between these two means that there's a lot less opportunity, or there's a lot more opportunity for carriers to jump into this market and get a better rate for what they have, even though the rest of the country is kind of soft right now. Chicago has been elevated, and we think a lot of that has to do with the intermodal presence in Chicago. It's a huge intermodal area. A lot of the freight comes in from LA, rails up to Chicago. Hence, you could use your FBX Panama spread at some point to kind of gauge, well, is it worth me sitting this in LA and railing it up to Chicago, or do I take it all the way around through the Panama Canal for $1,000 extra? You know, I think the cost to get from LA to Chicago runs around 1,800. I'm probably wrong on that, but it's probably somewhere in that area. If you were to do the math, you could figure out, well, I'm willing to wait an extra 2 weeks if it's not time sensitive freight. I go ahead and put it on a ship. I now save about, you know, there's obviously drayage and the truckload cost to get it there and whatnot, but that's where the Panama spread analysis would work as well. But getting back to the tender rejection.
Yeah, I'd like to go back really quick too. Yeah. Sorry to interrupt, but so as we see Chicago in beginning of July after Q2 with the US, you know, kind of going with that decline into the beginning of August almost, or end of July before Chicago diverges from the line. What can that tell us though? I know we see some volatility, but it looks like it's trending along the same line. So how can that be viewed? I know it's still quite a difference from the US
really what
overall.
Really what you're looking for in any kind of analysis on a chart is essentially this. You know, you want to see these movements up and down. So right here, you essentially have this resistance level. This is a bottom. If you're kind of doing a technical analysis, this is going to be your bottom. So anything that moves below this in the future, you're looking out for. If it goes below this, that's a big sign that you need to go ahead and just if you're a carrier, you're happy. If you're a shipper, you're real happy.
Yeah.
You're generally doing well. There's going to be enough capacity to take your freight. Now, the next thing you're looking for is kind of this top. If I put the crosshairs right here, there's a line that you can draw, and it generally puts everything kind of in this box. So we now have these two little spaces of highs and lows that we're watching for, because once it kind of bounces, you essentially want to make, like, this is where I'm kind of, if I'm in the stock market, I'm going to think about taking a long position in this market. This is basically where it bounces. I'm looking for elevated spot market activity during this ride up the ladder. Now, once it kind of stops moving, this is when I think the market may have found a new kind of equilibrium. This is where things kind of, even though it stayed out of the range of the rest of the country, it's still kind of flattened out. So we've got a new level of resistance on the top. So if I'm drawing this imaginary box around these two lines right here, and I'm waiting for it to kind of bounce back through, because right here in this section, rate probably not moving very much.
Right, because it seems that it's moving. It's experienced that initial volatility, but it seems like it's kind of moving along the same trend line of staying.
I'm going to use one of our fun tools right here to kind of draw circles. And right in here, that's where I'm focused on spot market activity. Through here in this section, I am really not, I really don't expect much to happen. This is kind of like, I've drawn a terrible box. Let's do that again. So right through here, I do not expect a lot of spot market activity or market volatility, even though it is elevated over States. It's still interesting that it's staying up here, and outbound tender rejections in Chicago. I want to watch volume where we had it. The volume spread specifically is going to be the first indication. But once I get it, so yeah, we've had a lot of technical issues today. So I hope some of this makes a little bit more sense. You know, I don't want to get too deep into the analysis of this, but if I am trying to get the most out of Sonar right now, I'm looking at my map for the volumes. I'm looking for any weekly changes. Then I'm coming to my charts, and I'm going to look at my volume spread to see if there's going to be any significant movements there. Then I'm going to go to my tender rejection index, and I'm going to see what's the normal pattern for this market. And I'm going to establish what's the norms, where are my big opportunities, and then once I establish kind of the short-term trend, did it break through? Yes, it did. Now I'm going, and now I can do action. I can make my action list. If I'm a
Right.
broker, obviously, I told you, we're adding more percentage points. I'm calling my carriers, making sure that I'm going to get my load covered. If I'm a carrier, I'm thinking about how I position my truck into this market.
What are you going to do if you're a shipper in this instance?
If I'm a shipper, I am making sure, especially this time of year, because it's end of month, right before a holiday, my tender lead times, I got to be on point with my planning.
Yeah.
Especially, I'm getting in front of some of this stuff with my production guys. If they're telling me that I'm going to have 15 truckloads come out over the next week, I'm now making sure that I get into my route guide right now and I start booking some of those loads.
Mhm.
That way, because I think we've already explained, like, some of these rates can jump as much as 15 to 20% in
Mhm.
one day. So if you're the last one to figure out that the market has deteriorated on you, you're going to have a bad earnings call in the next quarter, which we've heard plenty of, because it does seem apparent that a lot of these shippers do not have a full grasp, and they wouldn't. I mean, the
Mhm.
carriers and brokers tend to have a better idea of what's going on in their own world. These shippers, it's not their main job. You know, they go up and set up contracts with the carriers and the brokers, and it's their job to kind of manage transportation, and they're in it to make money. So the shippers need to be more aware of what's going on in this world if they want to take full advantage of the market itself, and make sure that they're not citing transportation costs in the next earnings call as one of the reasons they didn't make their OR or earnings.
Nice.
Yeah.
Yeah, I think that's very useful. And I think we got about 10 minutes left. So let's jump to our first question here. Or did you have anything else you want to cover really quick before we?
No, just wanted to apologize for the technical difficulties. It's kind of been a choppy webinar this week. Hopefully the internet cooperates in the future.
Yeah. And we'll have this recorded as well. So
Yeah.
those that fell off here we'll make it nice for you, so you won't have all the cutouts that we had during the live session.
Maybe you'll have a blooper reel in the middle of where we were offline and we were saying some really bad stuff.
Yeah, that's true.
Probably not, but carry on.
But yeah, so our first question is more towards questions around the data. Where does it come from? I think we looked pretty much all at tender related, other than FreightWaves. So FreightWaves being a third-party data source, so that we're of course listing our third-party data sources if that's where they're coming from. But in terms of the tender related stuff, where do we get it from, and what type of coverage do we have of the market?
FreightWaves or just the data in general?
No, the question was more geared toward what percent of the market are we covering with the data, and I think it was geared more towards the tender related stuff, because that's really
yeah. So our data comes from a variety of sources. We can't obviously disclose the source of it, but we do believe that we have captured approximately 80% of the contract freight market. There may be a little bit of spot market exposure out there, but a lot of our data sources come from places that our data scientists are, it's basically, it shows up and it just looks like a garbled mess. It's not organized at all. You don't even know what it is. And so they spend a lot of time making sense of it, testing it, and ensuring that it's reliable and it can actually provide value. So, I mean, it's a accumulation of sources from across, IoT, ELD, EDI, various places like that you may not even understand what it is if you saw it.
I hope you answer that well, because I was reading some of
I was actually kind of looking to you to kind of validate what I was saying, to see if I answered that appropriately. But if you have further questions, please again send us a message, contact us.
Yeah, I see the name, so I can reach out directly after if you didn't get to that. So we have another question. Do we have any, are we going to maybe create an O-try, I-try, so outbound tender reject index, inbound tender reject index spread?
We have been looking at that, and we actually decided to hold off on that for now, because one of the things, and this is it would be easier to show and illustrate on a kind of a whiteboard than it would to talk this through, but essentially the spread between the inbound and outbound reject rate it's only valuable, and the difference doesn't always tell you the same thing. So when it goes up, if you have diverging values on O try, I try, that you can actually tell what that's telling you. When they both go up, it stays flat. When they both go down, it stays flat. So
it's market specific.
Yeah,
so
it's very market specific. You're also going to have a lot more exposure to lower volume in those markets. Really what you're looking for is the sign change in those situations. And we haven't figured out a better, we found that actually the volume spread is a better, more consistent measure. But we are going to probably rework the difference between the O try and I try to come up with something that actually is a little bit more consistent with what is going to represent the market and what it's doing.
I think that answers that one. And then we have a question for the audience. We're taking any and all call-ins. Are Christmas trees? Oh, Zach laughed. There we go. Are Christmas trees transported via van or flatbed? I think I can answer that unless you want to. The answer
Go for it,
is both.
I talk the whole time. You can have at it, dude.
The answer is both. They're transported via van and flatbed, depending on the size, the amount, the weight.
They'll take whatever they can get at the time.
Especially at the time.
The flatbed market is highly volatile. If they're in the area at the time, obviously they'll gobble those up. They do love Christmas trees. They pay very well.
Oh yeah.
So
I think that is good on that one. And then with Texas having so many markets, how do you see the state as a whole doing in the coming months? What tools via SONAR would you suggest to view such market changes?
I love that. So again, I'm going to go back to the volume at first, and this is kind of the case for just about any market in general. Anytime you look at a market, you want to see what it's doing in terms of volatility. That's going to tell you where the freight is moving. For instance, right now I've pulled up the inbound tender market share map, which is it's similar to the inbound tender volume index, but it's telling you it's kind of like if you envisioned a pie, it's going to stay the same shape, whereas the tender volume index, it can grow and shrink. So, for instance, Dallas is losing real estate in that pie right now. And so that
could just mean their volume staying the same, but the volume of other regions in the country are growing, so they're losing some market share.
Exactly. But it also tells me that's kind of a section that might be at risk for a trucking deficit. The Dallas market has been losing market share gradually over the last month and a half. It was gaining quite a bit. I think I'll go ahead and pull up that chart real quick. I know we're running low on time. Let's just pull up the OTMS, Dow, and I would look obviously at Fort Worth and whatnot. And I would pay attention to the El Paso market and Houston over the coming months, just because one of the oil, but also because of the tariffs. We've seen some heated El Paso data or information come through. I mean, and the fact that you can see the market share really jump up and down in the Dallas market means that there's a lot of volatility here. It is a very transitioned market. You have a lot of warehouses, but you also have a good bit of production. Oil obviously has a lot to do with the capacity in the area, but there is a lot of freight that comes off the coasts, and it's a good midway point for a lot of trucking networks. A lot of people buy up real estate there for warehouses. I know everybody's heard of the Amazon effect. Dallas is a great, I guess around Dallas is a great spot to get some cheaper real estate. And also you have access to a large portion of the country and a lot of the population, depending on if you are a West Coast or East Coast provider.
Yeah. So I think in short, the market share of the Texas regions, I think even further looking at the spread as we showed, which will just be one number on a chart, but as of right this second for today, the difference in the outbound and inbound tender volume spread is kind of your second step, and then seeing what is happening step 3 with the tender rejections in those markets. And I'll even go one step further and tell me if I'm incorrect here. And analyzing Texas as a whole is you see maybe one of these major markets experience extreme volatility, it may pull capacity from the other. So you may see kind of a domino effect or chain reaction. So to answer your question, Texas as a whole, I would certainly, if you're Dallas heavy, Houston heavy, Austin, Texas heavy in the shipments or the quotes that you're doing, I would certainly monitor all of them, because I think they coincide with each other. And
Huge. I mean, Houston will suck capacity out of
Right.
Dallas real fast. San Antonio is not that volatile, but it can have an impact.
Yeah.
But anything around that region, again, I always think about the regions as kind of a hub and spoke. Dallas kind of services Houston, Oklahoma City, Little Rock, Memphis to an extent. New Orleans has an impact there. People moving freight into Florida and stuff. There's a lot going on there. So anything that's around those markets is good to look at, as they always kind of interconnect. Houston, Dallas, San Antonio, and then West Texas, Lubbock, which is a low volume area, but still those low volume areas are overlooked a lot.
Yeah.
I mean, if you can take advantage of some of these lesser known spots, you can actually be in front of the game.
Yeah, and I think as people continue to use Sonar a little bit more, they fall in love with the charts and charting things more often than they'll use the maps. But if you're looking at regions as a whole or surrounding regions, I think the map is really good to see what's happening in comparison to region to region, to give you an idea of what different regions are doing, how they're reacting, or what effect they may be having on each other. Especially with some of the time series. And what I mean by time series is pulling up any of these different tender related data sets, whether it be rejections, volumes, market share, and you can view their change over the past week, 2 weeks, or month. So you can get an idea of how that market and the surrounding markets are changing, over time, and what direction that they're headed.
Yeah.
I think that's all of the questions that we have. But what would a Sonar webinar be without a promotion or a deal at the end? So for anyone that is not a Sonar member, and those that already are, your monitors are en route. Do not worry. Sonar subscriptions now come with a 34-inch widescreen curved LG monitor. So if you're interested in viewing all of the great things that Sonar has to offer, as the FreightWaves team, the Sonar team views them here in our office in Chattanooga, you can certainly have that opportunity, and we'd love to send those out to you as part of your Sonar subscription. Any contact or questions through the Sonar team, sales@freightwaves.com. You can also find a lot, or pretty much all of the information you need, at freightwaves.com/sonar to request a demo, as we touched on earlier in the webinar. If you also just want to see more information on the data and how we transmit it, how often it's updated, all of that good stuff, it can be found on that website, which is also an export from the question mark in the top right of your Sonar dashboard for Sonar subscribers. Unless you have something else, Zach, I think we're all good. We are ready to sign off here.
Maybe the internet will turn it off for us.
Maybe the internet, if we're around long enough, it'll cut off for us. But that's all we have for this week. Tune in next week, 2 p.m. to the Sonar weekly webinar, Market Insights, and this will be viewable. Again, we'll post this on the Sonar website. If you kind of came in and out, we'll cut it up and make it a little bit more fluid for you to rewatch or view anything that we talked about here today.
Cool.
And that's it. Thank you. Have a good week.